If I had to name the one skill that separates business owners who feel in control of their money from the ones who feel at the mercy of it, it wouldn't be making more sales or even making more profit. It'd be cash management. So let me pull together what that actually means, because it's less complicated than it sounds, and it's really just a handful of habits. Cash management is the practice of making sure the right amount of money is in the right place at the right time. That's it. It's the everyday, practical version of what a company's treasury function does, steering and being in control of the cash instead of just watching it. And it comes down to 5 things. The first is knowing your actual cash position, not your profit, not what you're owed. The real, usable cash you have available right now. You'd be surprised how many businesses can't answer that quickly. And you can't manage what you don't measure. Profit on paper and cash in the account are 2 different numbers, and cash management starts with always knowing the second one. The second is understanding your timing. Money comes into a business and goes out of it on completely different schedules. You pay for things now, and you often get paid later. That gap between the cash going out and the cash coming in is the heart of cash management. It's the same gap that causes profitable businesses to run out of money. Once you understand your own rhythm of what comes in when and what goes out when, you stop getting surprised by your own account. The third is forecasting. And this is the big one. Forecasting just means looking ahead, a simple weekly or monthly view of what you expect to flow in and out. It's the single most powerful cash management habit there is, because it lets you see a shortfall coming weeks before it arrives, while you still have time to do something about it, instead of discovering it the day a payment fails. Forecasting is the difference between steering and reacting. The fourth is separating your money by purpose. Not all your cash should sit in one undifferentiated pile. The businesses that manage cash well mentally, or literally, divide it. The money for day-to-day operations, the reserve set aside for emergencies, and the cash meant for growth. When it's all mixed together, the money you need for a rainy day quietly gets spent on Tuesday. Keeping it separated by purpose is what keeps each part protected. And now the fifth is keeping a cushion, a reserve for the unexpected, sized to how steady or unsteady your business actually is. It's what lets you absorb a slow month or a surprise expense without it turning into a crisis. And it's also what makes your business look stronger to any bank or lender looking at it. Here's the shift that ties all 5 of these together. Cash management isn't about having more money. It's about moving from reacting to your bank balance to actively steering your money. The businesses that do this well aren't always the most profitable ones. They're the ones who always know where their cash is, where it's going, and whether they'll have enough for what's coming. Know your position. Understand your timing. Forecast ahead. Separate by purpose. And keep a cushion. Do those 5 things consistently, and you go from hoping the money's there to knowing it is.